You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 2nd of June, 2022, and I'm joined today by my co-host, John McEwen. In this week's episode, we'll be discussing Imperial Brands, Britvic, Royal Mail, Burberry, National Grid, Fiverr, and Just Eat Takeaway. John, shall we start with a favourite of the show, Imperial Brands?
Imperial Brands, so the second largest tobacco company on the FTSE 100 and owner of JPS Players, Lambert & Butler, Golden Virginia, Rizzlers. They had their half-year results out recently with half-year revenue, excluding the impact of exchange rates and duties, up 0.3% to £3.5 billion. Tobacco revenue grew 0.1%, whilst volumes declined 0.7%, with price rises offsetting the volume decline. Meanwhile, next generation products saw net revenue growth of 8.7%, with strong sales in Europe. Underlying operating profit rose 2.9% to £1.6 billion as next generation products losses fell 49.9%. If we break those results down a little bit further, then in Europe, revenues were down 2.2% to £1.6 billion. However, the group improved market share in the UK whilst losing some in Germany and Spain. The group noted that price increases in both the UK and Germany should feed through into the second half. Next generation product sales were more impressive, with revenue rising 44.7%, although not enough to offset the decline in tobacco revenues, meaning underlying operating profit fell 7.3% to £671 million. In the Americas, revenue was up 2.2% to £1.2 billion, with strong cigarette sales in the US. Next generation product revenue, however, declined 28.1%, with increased competition and discounted prices impacting. Underlying operating profit was up 6% overall to £453 million, with market share gains and lower costs from the next generation products. In Africa, Asia and Australasia, revenue grew 3.1% to £766 million, growing market share in Australia with the launch of Lambert & Butler as a value-orientated brand. Next generation products revenue went to zero with the exit from Russia and Japan, and overall underlying operating profit was up 25.8% to £357 million. The distribution division reported revenue of £502 million, a decline of 0.6%, with a poor performance in France and Italy. Underlying operating profits were up 1% to £119 million. And Imperial took a charge of £201 million with a disposal of the Russian business. Free cash flow came in at £336 million, and net debt fell by £1.2 billion to £9.8 billion, which is now around 2.4 times EBITDA. In terms of valuation, Imperial has a market cap of just over £17 billion and trades at just 6.8 times earnings, compared with a 10-year average of 10.3, and it currently yields 8.5%. Ethical issues aside, I think these were decent results from Imperial Brands in spite of the charge relating to the disposal of the Russian business, and the group remains on track to deliver full-year net revenue growth in the region of 0 to 1% and underlying operating profit growth of 1%. And the next generation products seem to be a mixed bag, although the losses are falling and there was a strong performance in Europe. I suppose what is more attractive about Imperial at the moment is that it trades on an extremely depressed multiple and is highly defensive. So in an inflationary environment, Imperial's going to be able to pass on those price rises to its customers. And I think that's really has been reflected in the sentiment towards some of the two big tobacco companies in the UK, which British American being the biggest, and Imperial's up 15.7% year to date, and British American is up 38.7% year to date. So I think it's that shift, and you've seen massive sell-off in tech, but then these two, probably the most defensive companies you can get, have performed strongly. And I suppose people are probably going to be buying these stocks for those defensive qualities and for that high dividend that Imperial and British American pay out. Although clearly many people will have ethical issues with the stocks, and I can't necessarily see the earnings multiples returning to what they were, say, 10 years ago. Even that wasn't particularly expensive for those reasons, and they're excluded by ESG funds too, and a lot of institutional investors. But yeah, generating lots of cash, even though it's an industry in structural decline. And I suppose some people might say, well, while it's in structural decline, there is something in those next generation products, even if they're nowhere near as profitable as their, I suppose, traditional products. Sam, what are your thoughts on these results from Imperial Brands?
I thought they were a bit lackluster. I thought they were all right. Like the stick revenue, it was okay. It's sort of what we come to expect. But I thought the next generation products was quite disappointing. I thought the drop in US revenue is disappointing. And I just think, although it's very cheap, British American tobacco is slightly more expensive, but it's also extremely cheap. And it's just got a much stronger portfolio of the next generation products, and it's putting up much better results. So for me, if I was going to have one of the two, I'd go with British American tobacco, I think.
I mean, I think it's if you're comparing the two directly in that industry, British American looks like it's the better business.
Yeah,
for sure.
And they're so cheap anyway. I know it's slightly more expensive to get British American, but it's still ridiculous. It's single digit PE, isn't it? So it'd be like 8 or something instead of 6.
Yeah. Should we just check that?
Just fact check.
Yeah, I don't doubt it. It's just more for listeners. 10.7
10. Yeah. 10 point. That's gone up a bit.
You're paying a lot. You're paying a lot more for British American, but like you say,
I probably still would. I think
probably still would.
I mean, it's still very cheap. It's just we've gotten used to it being like 6. 10.7. What's the share price done then since we last looked at it? It must be up a fair bit.
I mean, year to date, it's up nearly 40%.
That's all right.
And its dividend is just over 6% compared with 8.5% with Imperial.
I'd probably still go. I think British American looks like it's got more of a future just in terms of the delivery on the next generation. Yeah. So I'd probably go with that.
Do you think that means that Imperial could be a target for an acquisition?
It's the smallest, isn't it?
It's the smallest, yeah.
Yeah, so possibly. It does have some good brands. It does have some very good brands or very famous brands. So it wouldn't surprise me. But I don't know how valuable are those brands, because all the next generation stuff, it's not really the same brands. It's like new stuff like Blue and whatever they're called. So would the brands be as valuable as you move towards next generation? Because if you're just doing different ones anyway, you know, if there's no Golden Virginia e-cig, then how much is the brand worth?
Yeah, because I think Blue was the brand that they paid a lot of money for. Yeah, Blue, they paid $7.1 billion when they bought it from Reynolds in, I think it was 2014.
Yeah, that's like a good chunk of their market cap.
Yeah, and I think that
it's not really worked.
I think that's one. No, exactly. So I think they took a big hit on that, and they've been paying the debt off since. But I think you'd. I mean, we talked off air. You'd read Going Down Tobacco Road, and that had some interesting points about how the tobacco industry had attempted to diversify when it sort of essentially realised the products were harmful, and it didn't. It was an industry in structural decline, and how they might diversify out of that, but how their business ventures, which weren't in tobacco, had actually performed very poorly. I suppose Blue is potentially a similar example to that.
Yeah, although it's more in line with what they're currently doing than buying like a shipping business or like some of the ridiculous stuff they were doing.
Nabisco.
Yes, so yeah. I probably prefer it, but it's probably going to be a similar story where it's just not going to be as profitable as the core tobacco, but.
It's interesting anyway, but yeah, it was from Reynolds Tobacco, 7.1 billion in 2014. So
shall we move on to Britvic?
Yeah, Britvic.
So Britvic have come out with half-year results, and they've announced double-digit revenue growth with volume and pricing growth across all business units, continued growth in at-home channels, with out-of-home channels recovering back towards pre-COVID levels. Immediate consumption volumes are ahead of pre-COVID levels. And they've announced good progress against their strategic objectives, including additional production capacity in Great Britain and Brazil now operational, strong momentum across core brands, exciting innovation launches with core brand extensions, new flavors and new pack formats, and accessing new growth spaces with Plenish relaunched and Aqua Libra flavor tap launched. And they're commencing an initial share buyback of 75 million in the next 12 months, reflecting the strength of the balance sheet and confidence of the growth strategy. And that's a 75 million buyback on a 2.16 billion market cap. So the revenue was up 16.6% to 719 million. Statutory EBIT was up 35.8% to 67.1 million. The EBIT margin is up from 8% to 9.3%. Profit after tax is up 48.7% to 45.8 million. Basic earnings per share is up 48.3% to 17.2p, and adjusted earnings per share is up 27.8% to 19.4p. The interim dividend per share is up 20% to 7.8p, and the adjusted net debt to EBITDA is down from 2.8x to 2.2x. And if we look at the revenue by region, revenue in Great Britain was up 19.3% to 493 million. Revenue in Brazil was up 15.3% to 64.7 million. And revenue in other international was up 17.4% to 161.6 million. So the bulk of the business is in Great Britain, but the international is a sizable chunk and growing quite nicely. If we go into the slides, there were a few interesting things. So they highlighted that they'd successfully executed pricing action to mitigate inflationary pressures. In other words, they just upped the prices. In the GB market, they've highlighted that revenue was significantly ahead of 2021, up 19.3%, and ahead of 2020, up 13.6%. And that growth accelerated in Q2 to 21.8%, but Q2 last year was impacted by lockdown, so it does have an easy comparative. They've said that Pepsi, Tango, 7-Up, White's, J2O, Lipton and Fruit Shoot are all in double-digit growth in the UK. In Brazil, they've said that they've got growing share in core categories and they're scaling innovation, and pricing action has been taken to mitigate continued inflation. They've also got a new leased manufacturing facility to drive vertical integration, and they're building a portfolio of premium, higher margin brands to broaden their channel presence and access growth opportunities. They've also got a little graph which shows the market share in terms of volume of drinks sold from 2015 compared to 2022. So in 2015, they had a 51% market share in liquid concentrates, and that's up to 77% in 2022. In RTD juice, it's up from 14 to 34%. Coconut water, it's up from 0 to 17%. Grape, it's up from 0 to 11%. And kids' drinks is up from 10 to 21%. So it looks like they're doing a pretty good job in Brazil. And in other international, they said they've got a positive trajectory across all markets in H1, with Ireland revenue up 23% and France revenue up 11.8%. And the France revenue has all brands in revenue and market share growth. In terms of the valuation, the business is trading at a market cap of 2.16 billion, has a yield of 3%, and is at a PE ratio of 18. I think 18 is not cheap, but this is a quality business. It's so far been able to offset inflation via price increases, and I think it can continue to do so. And I think it's got very good growth prospects, because although it's pretty saturated in the UK, I think the international is a big opportunity to carry on growing. So I quite like it at 18 for a business of that quality. John, what are your thoughts on these results and the valuation?
I mean, I thought they were really decent results. I mean, 48.8% increase in profit after tax. I think the brands are really strong. It's a bit more exciting with the prospects in Brazil. I was just going to ask, how do the numbers compare with pre-pandemic levels?
They're up on pre-pandemic. I did have it, or maybe I just gave the UK one. So in the UK, I don't have the figure for international to hand, but in the UK, which is about, I think, 2/3 of the revenue anyway, that's up 13% compared to pre-pandemic.
Okay, fine.
So it's up quite a bit on pre-pandemic.
Yeah, very good. And it's got a decent yield, which is well covered. And then, I suppose it is all of this is baked into the share price. Would I buy some? I think it would probably go onto my watch list. I've definitely got a lot of consumer goods companies in my portfolio.
Too many.
I can't have too many. But yeah, I think, good company. And it will definitely go onto the watch list, in fact. Not sure whether I buy shares or not, but I like it.
So for that dividend yield, it's possibly worth mentioning as well, they pay out 50% of the profits as dividends.
Okay.
So you're never going to be in a position where you'd hope where they're doing something stupid to pay the dividend. If the profits drop, the dividend would just drop with it.
Yeah. That's more sensible than some companies for sure.
Yeah, I like that kind of policy. So shall we move on to Royal Mail?
Yeah. Royal Mail. So different sort of company altogether. They had their full year results out recently, with full year revenue rising 0.6% to £12.7 billion, with strong numbers from the European GLS business helping offset declines at Royal Mail. Underlying operating profit was up 8% to £758 million. And in the Royal Mail, the main business, revenue was down from £12.7 billion to £12.6 billion, with a 13% decline in parcel volumes. And this is still, it's to be said, 16% ahead of pre-pandemic levels, with domestic parcel volumes remaining higher. The return of junk mail and advertising meant that letter volumes grew 3% overall, although they're down 18% compared with 2020. The ongoing cost-saving program contributed to operating costs falling 2.5%, and operating profits were up from £344 million to £416 million. The GLS European business saw revenue rise £4.2 billion compared with £4 billion last year, and with a 4% increase in volumes, with the increase in business-to-business sales and growth across all geographies. However, operating profits were hit by driver shortages, and inflation falling meant that they fell 4.5%. And free cash flow came in at £420 million, down from £770 million, with an increase in capital expenditure, particularly the investment in automation in the Royal Mail business. Net debt increased from £475 million to £985 million. And going forward, if a pay deal can be reached around the current offer from Royal Mail, it's expected to have adjusted operating profits in the £303 million mark in the next year. GLS, meanwhile, is targeting operating profits of between 370 and 410 million euros. In terms of valuation, Royal Mail has a market capitalisation of £2.8 billion and trades at just 6.5 times earnings, compared with a 10-year average of 12.1, and it yields 6.8%. And for reference, the shares are down 34% since the Royal Mail was privatised 9 years ago. I thought these results were broadly what you might expect from the Royal Mail, and I suppose it's good, obviously good to see that the profits are rising, but I think there are a lot of long-term tailwinds like e-commerce, which the business is continuing to benefit from, although you could argue that it should be performing better given these. And the legacy business is costly, and then it's got the highly unionized workforce, which would make me think that it's much less competitive than some of the other operators in the space. And I suppose that's part of the reason why it trades at such a depressed multiple, just 6.5 times earnings. I think if I were looking for a business in this space, I would choose one of its competitors that doesn't have all of those sort of legacy headaches that Royal Mail has. So even at that sort of depressed multiple, it wouldn't be one for me. What about you, Sam?
Pretty similar. It is very cheap, and that dividend yield looks excellent at 6.8%. But yes, I do worry about it, especially because the letter volumes are a much higher proportion of the business than Deutsche Post, which we covered a few weeks ago. I wouldn't touch anything with that highly unionized anyway. It is pretty cheap, but I think I wouldn't touch it the same as you. But even if it's a sector I wanted, I'd rather just pay up for Deutsche Post. I thought it looked like a much better business.
Absolutely.
But
and it's one that's very competitive as well. So when you've got those handicaps, it's I suppose people would argue it on a valuation basis, wouldn't they?
Yeah, but then the profits can always fall into the valuation, can't they? So
that's right.
And that would be my concern with Royal Mail, because I think although it's had a lot of tailwinds, like you say, it is competitive. And if the parcels do start to decline, because they are still at elevated levels, we don't know if they're going to drop back down. And we've seen a lot of stuff. It has just returned to normal now. So I would worry about that. But it is very cheap.
Yeah. Cheap for a reason. Okay. Possibly. I don't think there's much more to say on Royal Mail then. On to a better business, Burberry.
Yes, Burberry. So Burberry, the high-end fashion retailer, isn't it? I guess they have come out with their full year results, and full year underlying revenue rose 23% to 2.8 billion, which was 10% ahead of pre-pandemic levels. This reflected a favourable mix of products sold and a double-digit rise in comparable store sales, which were up 6% versus 2020. Underlying operating profits rose 38% to 523 million, ahead of expectations, as full price sales rose 24% year over year. Burberry announced a final dividend of 35.4p, taking the full year up 11% to 47p. The group's also planning a 400 million share buyback scheme due to complete in 2023. Let's check the market cap on that, because I think that's quite high. It's the market cap's 6.89 billion, so 400 million buybacks, pretty chunky actually. The group expects to perform in line with targets for the medium term, but noted that the impact of COVID on consumer spending in China could create some near-term uncertainty. We've heard that before. If we break these results down a little bit more, overall comparable store sales were negatively impacted by renewed lockdown restrictions in Asia in the fourth quarter. This meant growth was weighted to the first half. Full price sales saw growth across all product categories. Comparable store sales in the group's largest geographic region, Asia Pacific, rose 13%, with full price sales up 29%. Regional lockdowns impacted performance in mainland China, but comparable store sales still rose 37%. Limited tourist traffic meant South Asia Pacific and Japan posted declines. Europe, Middle East, India, and Africa saw comparable store sales fall 18%, with full price sales down 11%. This was largely due to lower tourist spend, which historically made up roughly half the region's volume, with continental European spend up 30%. The Middle East continued to grow, with both domestic and tourist demand on the rise. Comparable store sales in the Americas increased 28%, with full price sales up 86%. This was driven by full price sales growth in the US, which nearly doubled as new and younger customers adopted the brand. Overall retail sales rose 20% year on year, while wholesale revenue was up 35% over the same period. Underlying operating profits for the combined retail and wholesale divisions were up 41% year over year to 486 million. Licensing saw revenue and adjusted operating profits rise 11% and 10% respectively compared to 2021. The group completed its efforts to streamline its estate, with 35 stores closed over the year and 38 opened. The group redesigned 47 stores and plans to open 65 under the new format this year. Free cash flow declined slightly to 340 million, reflecting lower COVID-related lease rebates and changes in inventory positioning. Net debt, including leases, rose from 101 million last year to 179 million, 0.2 times underlying cash profits. So you don't need to worry about that at all. In terms of the valuation, the company trades at a P/E ratio of 15.3, and that compares to a 10-year average of 20.3. And the prospective yield over the next 12 months is 3.4%. I think these are very, very good results. I think things look quite encouraging. They've got a new CEO in recently, and he's wanted to reposition the business more towards the higher end because they were doing a lot of discounting. I know they've got some tailwinds as they recover from COVID, but it appears like that strategy is working, especially if revenue is now ahead of pre-pandemic levels. And I think there's still quite a bit of growth possibly still to come. So it's a PE of 15. I think that's pretty reasonable. It's interesting because I think we covered this on the show about 12 or 18 months ago. And it was basically, it was priced at around £20 a share. And we were saying that, although we like the brand, it was priced as if it had already recovered.
Yeah.
And then what's happened is the business now has recovered and the share price has actually gone down. So if you'd held it a year ago, you'd be down 20%.
But do you think that's more now because we've got sort of what many people think is a recession on the horizon, and you're a luxury brand going into a recessionary environment? Is that the reason for that depression?
Possibly, but I think it's more attractive now than it was a year ago. Like not just in terms of the share price, but the business as well. But yeah, what are your thoughts on these results and the valuation then?
I mean, I think if you don't look at the macro side of things, I think the results look good. And yeah, for 15 times earnings for such a strong brand and a healthy balance sheet, it is very attractive. And things don't go sort of on a global scale as badly as you think. It's probably a good time to buy in, I'd say.
But should you really be worried about the macro though, or should you just take the view it's a good business at a good price?
Business. Yeah, you should probably do that. And yeah, that's what I try to do. But it is difficult, and we are human.
Good enough for the watch list?
I think so, yeah.
How does it compare to previous times we've looked at it? Because like you say, the business is the best we've ever seen.
Yeah. I think I'd be more. I would probably, everything that I've just set aside, I'd probably be more likely to buy it now than I have been at any point in the past.
You're taking your own advice then.
Yes.
So should we move on to a business I think it's more unlikely to buy?
Yeah, that would be fair to say. So National Grid, the FTSE 100 listed utility company, also had their full year results out recently, with full year underlying operating profit up 11% to £4 billion. There was higher UK electricity transmission revenue. Breaking the results down into division and geography then, the UK electricity transmission business saw higher net revenue and adjusted operating profits rose 10% to £1.1 billion. Investment in the network rose by 21%, with the regulated asset base 8% higher. Return on equity was down from 13.8% to 7.7%, with the impact of the lower base return. In the UK electricity distribution division, which includes the recently acquired Western Power distribution business, reported results from the time of acquisition, 9.5 months to the 31st of March. Thus, underlying operating profit for the division was £909 million and the return on equity 13.6%. The division agreed to pay out £14.9 million after an investigation found that customer advice and services were inadequate. The UK electricity system operating ESO saw a rise in the net revenue, and adjusted operating profits rose to £7 million compared with £7 million compared with a £60 million loss, with recuperated payments from the previous period. This part of the business is due to be sold to the government as it aims to create an independent future system operator to help the energy transition. In the States and New England, adjusted profits rose 22% to £743 million, with higher net revenues and higher rates, plus new customers. Return on equity was 8.3%, which is not far off the 9.8% permitted by regulators. In New York, adjusted operating profits rose 17% to £780 million, giving a return on equity of 8.8%, which is 99% of what is allowed, with efficiency programs and lower storm costs also helping. The National Grid Ventures division saw profits more than double to £307 million, with a majority coming from the grain, liquid, natural gas and transmission businesses. It's also worth mentioning that the UK gas and transmission and metering businesses are due to be sold this year. National Grid generated £5.8 billion in cash from continuing operations, nearly £2 billion lower than last year due to the Western Power division contribution. Following the £5.8 billion spent on capital expenditure and investment, and the £2 billion paid in interest and dividends, the group had a total of a £1.6 billion outflow. Net debt rose from £28.5 billion to £42.8 billion, reflecting an £8.1 billion in debt taken on through the Western Power division and £8.2 billion in bridge loans to finance the acquisition. In terms of valuation, National Grid trades at 18.3 times earnings compared with a 10-year average of 14.3 and currently yields 4.3%. I thought these results were fair. And I mean, I suppose it's good to see National Grid's transitioning further with the sale of its gas division, but it does have a lot of debt. And I think when you look at utility companies, you think that they've got regular, predictable revenues and a regular dividend. But I think what really worries me, aside from the debt, is that the government is now intervening and regulating even further. And we've seen the windfall tax that was announced just in the last week. And it's that sort of, I suppose, the regulatory uncertainty. And these are the sorts of businesses that don't produce stellar results, but even when they are, profitable industries, if they're going to be hit when they do perform slightly better than usual and taxed further, that's something that would really worry me and probably put me off investing anything in the sector. What are your thoughts, Sam?
Right, very, very similar to that. I don't like the regulation. I think if you're buying it, you're basically really this is a business that, if we're being honest, is bought by the oldies for the dividends. That is, no one's buying this for growth.
Yeah.
And when you look at that dividend, I think there's a strong argument to be made that they shouldn't be paying it because the debt is huge. It's a lot of debt. And they are doing that because they know if they drop the dividend, they'll get hammered, because that's pretty much why everyone's in it. But
yeah, I
don't like it at all. I really don't. At the level of debt, I would be uncomfortable with that. I mean, the debt's equal to the market cap.
Yeah.
When they're taking out bridging loans and stuff, I mean, that's not great because you'll get a high level of interest on that. I don't like it when they're using debt to fund dividends, and that's basically what they're doing, which I do not like. So yeah, it's not for me. Wouldn't touch it.
And what do you think about the regulation?
I mean, it makes me uncomfortable anyway. Yeah. But yeah, like you said, we've had the windfall tax for all the oil companies, and these don't fall into the windfall tax, do they?
No, certainly not at the moment.
Not at the moment. But that's my concern. That if they start having a good time, they're just going to get hit with a windfall tax because. I know it's meant to be a one-off, but income tax was temporary.
Yeah, well,
and here we are 100 years later.
With the windfall tax, we're talking about it going on to 2025 at a minimum.
Yeah. There's nothing as permanent as a temporary tax, is there?
Exactly. And if and this is a Conservative government, you'd imagine would be less likely to implement such windfall taxes. And if they're doing it, and if you say, well, if they're not in power, then it's more likely to continue for even longer. So I think that does undermine a lot of confidence. I mean, even in just investment in the UK as well, if you have a sector that performs well, if you're just going to bash it with extra taxes because it's performing strongly.
And then you wonder why no one's investing.
Yeah, that's right. And particularly if they have high capital expenditure costs, you think twice about it.
Well, yes. Well, we talked about this before a couple of weeks, but when we covered the oil companies in the pandemic, they look like absolute dogs. They look dead, and no one was coming in to save the day.
Yeah,
and now the oil price has gone up. All of a sudden, they want some of that. But
of course,
weren't happy to share in the losses, were they?
No, that's right. And I think when you've got cyclical industries and ones that do have high capital expenditure, how can you operate in that environment when you need to?
We've got the extra tax on the big house builders as well now.
Yeah,
it's just, like you say, for a cyclical, if they're going to start taxing at the top of the cycle, it makes it a lot less attractive as an investment.
Absolutely. I think it is a bit worrying, and I think if you're going to be sort of a business friendly country and you've left the EU now, you don't want to be doing that sort of thing.
No,
it doesn't make you inclined to go and list in the UK compared with a country like the States.
Yeah, I agree.
But I suppose what you might argue is that the big companies like Shell, it's reflected in the share price that they are a lot cheaper than their peers in the States.
Yeah, but that's if they don't decide to tax them more. I wouldn't say that's priced in. It's just the uncertainty. I think that's the concern.
Yeah. Yeah.
Anyway.
Not one that I'll be buying shares or even close to buying shares in. Probably one of those ones that is waiting to be for the share to be hit. Really, I don't think that bad news is in that share price at all. It's certainly if you compare it with some of its peers like Centrica. I know it's
expensive as well.
Yeah,
I don't really
exactly.
know why.
Exactly. You don't feel that it should be trading at that multiple.
No.
But it's not baked in. But anyway, we'll see what happens. So US company of the week, Fiverr.
Yes. So Fiverr, for anyone who doesn't know, we talked about it a bit in the second part of the interview with Luke Hallard that came out last week, but it's one of the outsourcing companies. So you can go on there and basically you can hire someone in India or Romania or some other cheap part of the world to do work that would cost you pay through the nose for, certainly here in the UK. So, for example, our intro and logo, they were both from Fiverr. And I think the total for the two of them was less than 50 quid. Whether or not we got our money's worth, I'll leave for you to decide. But we would have paid a lot more for both of those if we'd found a firm in the UK. So they have come out with their Q1 results for 2022. And they've highlighted the new catalog experience on Fiverr Business. We rolled out our major upgrades to the browsing experience on Fiverr Business, putting talent at the forefront to provide a more intuitive search experience for business buyers, while the e-commerce experience provides conversion and transaction efficiencies. They've launched AI Audition, which a Fiverr hackathon winner idea turned into the latest innovative products on the marketplace. It allows buyers to input their text and listen to a sample narration from a voiceover seller instantaneously, all powered by AI. Strong brand awareness. A recent US brand survey conducted with Ipsos indicated that Fiverr is the strongest freelance marketplace brand in terms of both aided and spontaneous brand awareness. Our US brand awareness is also growing fast, speaking to the effectiveness of our long-term continuous investments into our brand equity. In terms of the financials, revenue in the first quarter was $86.7 million, and all these figures will be in dollars, which was up 27% year over year. And that's on top of some very, very tough comparatives. They grew they went bananas in the pandemic, as you'd expect. Active buyers as of 31 March grew to 4.2 million compared to 3.8 million a year ago, an increase of 11%. Spend per buyer reached $251 compared to $216 a year ago, an increase of 17%. Take rate for the first quarter was 29.6%, up from 27.2%. GAAP gross margin was 80.4%, a decrease from 83.1%. The GAAP net loss was $17 million or 46 cents a share compared to $17.8 million or 49 cents per share a year ago. For the financial outlook, they are guiding for $345 to $365 million of revenue, and that's year-over-year growth of 16 to 23%. Ofer Katz, the president and CFO, said, "Our solid results in the first quarter demonstrate the resilience of our business and ability to execute amid volatile macro conditions. We are very pleased with the ongoing momentum in Fiverr Business and the exciting upmarket opportunities ahead of us. Our strong balance sheet and disciplined financial strategy provides a solid foundation for us to continue investing for growth and long-term shareholder value." So in terms of the valuation, they trade at a market cap of 1.484 billion. And that puts them at a price to sales ratio of 4.7x. And that's 4.7x on the trailing 12 months. So that doesn't include the next 3 quarters where they're expecting 16 to 23% growth. So that would come down even further. And if you were to look at the price to gross profit, which I don't think is unreasonable, given that a lot of the money is being pumped back into marketing and sales and R&D. And when they do eventually get to scale, I think this is going to be a very, very profitable business. I think the price of growth profit is not the worst indicator you could use, but that's only at 5.75x. For context, this is a business that was trading at about 40x sales, possibly the last time we looked at it, although I think it'd come down to 17 maybe. But we looked at it at one point on the show and it was at 40x sales. Market cap was something like 12 billion. So it's down about 90% from the peak. And it's now looking, I think, very reasonable. I'm biased as a shareholder. So in fact, I'll just find out what the peak was. So it looks like the shares peaked at, I actually think it's been higher than that. I don't. But anyway, what I'm looking at, it gives a peak of $269, currently trading at $40 a share. I bought at $120 and then it dropped to $60. And I thought, well, how much lower can it get? The answer was at least a third. I wouldn't be averse to topping up again, actually. I really like the business. Execution's fantastic. Valuation's looking the most reasonable it ever has. And what I like about it is that 1.4 billion market cap is tiny. And I think when you look at the industry it's in, I see it being a big, big industry. I don't know if it'd be Fiverr, but I could see there being a business in this industry that's $100 billion business. And it might not be Fiverr. It might be that Microsoft come and take a slice or something because they're doing similar stuff. You've got Upwork too. But I think there's a lot of room for growth. I think it's very reasonably priced now. John, what are your thoughts on these results and the valuation?
I mean, I think it's very, like you say, it's very impressive to have that level of revenue growth, particularly on the comparators with last year and I suppose on the back of COVID, which is obviously a massive benefit for the business. I mean, obviously, I'd like to see a company with earnings, but I get it's not at that stage yet. It's very much in the growth stage, and I would agree with you. It's a growth industry. What I was going to ask, because it's not a business that I know a huge amount about. How would you say it compares with Upwork? And are there any other big players other than Upwork and Fiverr in this sphere?
I think Upwork and Fiverr are the main ones. The only other one you'd maybe say is what about Microsoft with LinkedIn, I guess.
How does so tell me elaborate on that a little bit more in terms of how
LinkedIn is like you can use it for hiring people. So I guess you could use it for outsourcing too, but it's not really what it's positioned for.
Okay.
But you definitely wouldn't rule Microsoft out.
Yeah, sure.
But Microsoft would be more likely probably to just come in and buy one and go compete. But yeah, so in terms of Fiverr's got higher growth rates, but it's smaller. Upwork's a market leader with smaller growth rates, but still very respectable growth rates. So in the pandemic, I think Upwork's growth rates got up to about 40%, whereas Fiverr's were more like 70. Historically, Fiverr's been more designy, so stuff like one-off jobs like we've used it for, like logo and the intro. Upwork's more, on my point, Fiverr trying to change this. So there's going to be some overlap there is overlap between the two because they're trying to, get into each other's territories. But if, for example, we decided we were going to start getting the podcast transcribed so it'd help the SEO on Google, I'd probably go and find someone in India that was advertising on Upwork. So it'd be more for like a sustained series of jobs is what I'd view Upwork for.
Yeah.
But they are both trying to change that. But I just think the market could be so big that I don't see any reason why they can't both do very well, especially when the market caps are so low and the growth rates are still so high. So I mean, to put up 27% growth on top of the pandemic figures is fantastic.
Yeah, absolutely.
I think as well, going back to the valuation, because like I say, they pump so much they pump all the earnings back into the business. So they've got, if you stripped out the sales costs, the marketing costs, the R&D costs, and said, well, if they just wanted to maintain the current position, what would they be at? I think you'd be very, very conservative to say that if this business wanted to, it could stop growing and or reduce growth significantly and have like a net profit margin of about 20%. Sure. And at the current, that would put them at a PE of under 25. But obviously you don't want them doing that. You want them putting it back into the business. So it's slightly, which is why I think the gross margin is possibly more useful to look at, because that gross profit margin of 80% is not going to be, this isn't going to be like a 5-10% margin business at the other end. It's probably going to be like 25-30% plus, I think. And if you looked at it on that basis, it's actually pretty cheap, especially for the growth it's probably still got ahead of it.
So would it be Fiverr for you over Upwork, or would you take more of the basket approach?
Well, I've got both. So yeah, Fiverr has a better track record. It's delivered better, but Upwork's the market leader and it's still doing very well. Upwork, the CEO that they had when they went public, I don't think he was really getting it done. So they got a new woman in. I think she's called Hayden Brown from memory, but she's turned it around. It's gone, it was really a business almost. It was like looking like a business in stagnation. The growth rates have picked up. And I think if it carried on under the old leadership, Fiverr probably would have overtaken it by now. And that hasn't happened yet. But I like both of them. And I think it'd be very difficult to predict which one would be the winner. And I think they could both do very, very well. So yeah, I've just got both of them.
Fair enough. Okay, then. Right. Well, that's all of the companies.
Well, we've got a bonus one.
Well, I was just coming on to that, Sam. So it wasn't really a bonus one. It was just to give a bit of an update with some of the news from what was an Investor Way favorite, which was Just Eat Takeaway. And we talked quite a lot about Grubhub and the valuation, Grubhub, and that we didn't like that acquisition by Just Eat Takeaway. But interestingly, they're preparing to take a multi-billion-pound write-down of the US business, and they bought it, for reference, for $7.3 billion, so about £5.8 billion less than a year ago. And they're planning on selling it, and it's estimated that they might get as little as £1 billion for it. So more than, close to 5 billion that they're essentially writing down. I don't know whether there's much more to say about it, really, other than it was an absolute disaster of an acquisition.
Yeah, I think every single executive associated with that acquisition should go. Just because I think it's such a horrible waste of shareholder value. And I don't think it's something you can look back at and be like, oh, well, if it worked out, because I don't think it's hindsight bias. We'll talk about stuff on the show every week, and sometimes we get stuff wrong and sometimes we get stuff right. But on this one, to me, it seemed very, very obviously a bad fit. Because I remember I was looking at one of the times we covered it, I was looking through an investor presentation or the results or something. And they made a big point that their strategy was to focus on, basically, they were the number one or number two, I think, in all their markets. And they were focusing on, market leaders. And that was the strategy. And then they go and acquire Grubhub because they want to go to the US. And Grubhub was the third biggest with a decline in market share. And it had previously been the biggest. So it was it's very much on the decline. And we said at the time, it does not fit into their strategy. Whereas if they'd done it and it fit into the strategy and just hadn't worked out, I'd be more sympathetic. But they were looking to do a deal in America, and they found one, regardless of whether or not it was actually a good investment. But if they'd listened to the show, they could have saved $5 billion or £5 billion for the shareholders. So can't put a price on our advice, can you? Clearly, well, you can, about 5 billion.
About 5 billion. Okay, fine. So, of the companies this week, Sam, which one would you buy? Or which one would you be most likely to buy?
For me, it would probably be Fiverr. I've already bought it at 120 and 60, and it's now at 40. I wouldn't be averse to topping it up again. If we exclude that one on the basis that I've actually topped it up a couple of months ago, so I won't be adding to it just yet, it's probably between Britvic and Burberry. I'd probably pay up for Britvic. I just like that a little bit more. What about you?
It would be Britvic. I think it's top quality business, and a little bit expensive, but I think that's, you get what you pay for, don't you?
And it does have good growth prospects. Yeah. Whereas, it's trading at the same P of National Grid. And I'd feel more confident about Britvic.
I know which one. Yeah. I know which one I'd rather have. Yeah, absolutely. Okay. Right. Well, thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.